Um, Glad to have you with us this afternoon as we talk about an exciting topic, especially for clubs that want to receive larger gifts, which I know is pretty much all clubs. Next slide, please. Talking about gift planning, and I call this gift planning as opposed to planned giving, and we'll get a bit into that as we go through today. But the basic idea that people should help and support one another, of course, is a core tenet of philanthropy in the United States. Charitable giving and philanthropy itself has evolved over the years, and a big change has happened, really significant changes over the last 10 to 15 years. And it's more exciting now than ever. It's more involved with people's estate and financial plans than ever, and today's a great day for planned giving. Donors are seeking for more meaning in their lives, and one of the ways in which they find that meaning is by becoming involved intimately with their favorite charities and our clubs. They have actively engaged charities in dramatic ways, and more than ever, donors now demand accountability. And that's why we continually talk about the impact that we're having on kids' lives. Donors want to see the impact and the long-term outcomes of their philanthropy. They also seek to integrate their philanthropy into their overall tax, estate, and financial planning. Next slide, please. From the advent of the first fundraising programs, individual giving programs, donors were asked to include their favorite charities as a beneficiary in their will or living trust. In fact, when we refer to planned gifts, the will or estate bequest is by far the most popular type of planned gift. Over 80% of all planned gifts are will or estate bequests. These deferred planned giving programs years ago were heavily focused on the vehicles like bequests, charitable gift annuities, charitable remainder trusts, charitable lead trusts, and they really weren't focused with a great deal of concern for the donor. But starting about 15 years ago, really started to change in the 1990s, and for the good, for everyone, I believe. The 1990s brought us gift planning, which is also called charitable gift planning, and gift planning programs put the focus on meeting the needs of the donor first, basic needs that the donor has, whether it's someone who just has to give, they're so generous, or they would like to receive income in exchange for their gift, or they've got such a large estate that if they don't do some planning, particularly charitable gift planning, they're going to unintentionally, as I say, make Uncle Sam their favorite charity, which most people don't want to do. So nowadays, the donor-centered approach makes sure that first we are meeting the donor's goals in their giving. And of course, those goals are also coordinated with the goals of the club. So it's not either or, it's both goals being met, the goals of the donor and the goals of the club. Next slide. Let's define what gift planning is. We can also call it planned giving if you prefer, but planned giving, the reason I don't refer to that too much when I'm talking with donors is that most donors don't recognize that term. A study was done years ago and they found out about 37% of all donors recognize the term planned giving. But if we say we're going to find out what the donor's goals are in their giving, and we're going to assist the donor, working with their advisors many times, to plan the very best gift for the donor and for the club, that's something more that they can relate to. So planned giving, gift planning, is the integration really of donors' goals in the personal, financial, and estate planning areas, along with their philanthropic planning goals. It's an opportunity really for charitable giving in circumstances that may not otherwise allow a donor to make a significant large gift to a club. One key statistic that you'll want to remember, especially as you're looking at individual fundraising, individual giving at your clubs, is that 95% of all individually owned assets by individuals in the United States are non-cash, which means you're looking at stocks, you're looking at property. If you're only concentrating on cash gifts, and don't get me wrong, there's nothing wrong with cash gifts, but if that's all you're concentrating on and you're not looking at these other asset-based gifts, what's happening is we're leaving 90% of the potential gifts on the table, and the ones that we're leaving on the table tend to be the largest gifts that an individual ever makes. So we need to broaden our ideas and our goals to include not only cash gifts, but gifts of property, gifts of stock, gifts of businesses, gifts of IRAs, gifts of life insurance, and so on and so forth. Next slide. Again, we're talking about integrating the donor's personal goals and their estate and financial planning goals and their giving goals, their charitable giving goals. As a matter of fact, we said a lot of times that, you know, when we look at what people want, we can come up with many things, but I say many times people want three things. They want peace of mind, a good night's sleep, and to leave a lasting legacy. A Leave a Legacy program emphasizes a donor's planning opportunities in three primary areas, and you'll see that over to the right. Their estate plan, which is their legal documents, including a will, trust, durable powers of attorney, etc. And then in the financial plan, when we're talking about their investments, their retirement plans. And finally, the third area is legacy planning, and we think mostly about will bequests and other types of planned gifts, and then also major transformational current gifts. Some gifts are, even though they're current, are going to need planning. The planning could be as simple as, is it better for me to make a gift of this appreciated stock, or is it better for me to write a check? That's planning in the simplest forms. Stock gifts are going to be very popular as we come into the year-end giving season. If someone paid, for instance, $10 a share for that stock years ago, and now it's worth $100 a share, if they gift that stock to your club, they're going to be able to take the tax deduction at the $100 a share price. So it's a great deal, many times a better deal than them just writing out a check. So what requires our attention really, and that we realize as development staff, is that this whole thing requires that we develop significant relationships with the donors, with our prospects, to understand what impact they want to have today and also what outcomes they hope to achieve tomorrow. And then beyond tomorrow, what legacy they desire to create during their lifetimes. We have a whole other training exercise where we talk about how to set up appointments, face-to-face visits with donors, and what are some of the questions we want to ask when we get before the donor. If it's a stewardship visit, it's very important to draw the donor out after we thank them for their giving and show them how their gifts are being used, to find out what their goals are in their giving to our club, where they want to go in the next 1 to 3 years in particular with their giving, with their involvement in the club. I've always said, when in doubt, ask the donor. They'll tell us. So, good thing to remember. When this type of planning approach is implemented, It meets donors' personal planning goals. It reinforces and passes donor values to their family and future generations, and it creates meaningful legacies for the donor, the donor's family, and our club. So really it's a win-win-win. Next slide. The philanthropic planning model. Here is the equation for success. You are the gift planner, plus the donor's professional advisors, that is their attorney, estate planning attorney, financial planner, plus philanthropic planning. That means the donative intent of the donor is very important. I was talking to a club a couple weeks ago, and they had a donor or prospect, I should say. The person wasn't a donor yet, but they were really not. They were getting the idea that this particular donor wasn't all that interested in the club, but more or less the financial benefits only of that gift model. And we have to be very careful. It's very important that that donor has donative intent, that they want to help our club. Yes, many times with planned gifts, there are going to be some really nice benefits financially, tax-wise, etc. But it's important that their first goal is making that gift to your club. So we've got the gift planner, the advisors, the gift planner, and the donor having donative intent. That equals the gift. That equals philanthropy. In order to reach this goal, charities no longer can work directly with donors without involving their professional advisors. And sidebar, we have a turnkey program where each of your directors of consulting would be happy to work with you to show you how to build collaborative working relationships with professional advisors in your area. One of the things that's become more and more prominent, almost 40% of individuals who learn about charitable giving and these types of plans learn that from a professional advisor. So it's very important that we have them on our side and they understand that we're doing this in a professional manner. I found out real early from one of my mentors, he said one of the quickest ways to kill a planned giving program is for us to, as gift planners, do an end around, so to speak, past the advisors. We want to bring those advisors in right away. And when you think of it, a lot of these advisors are already meeting with some of your donors and your key prospects. They have them already as clients. So it's a matter of showing them how adding charitable estate planning to their model can greatly help them grow their business and greatly help the community and each of our clubs. Next slide. In this presentation, we're going to discuss the most common types of gift plans, which you'll see up on the screen here momentarily. We are going to go through each type individually and explain the benefits. The most common, again, is Bequest, about 80% of all planned gifts. Next most common is charitable gift annuities. They amount for about 10% of all planned gifts. And then the remaining 10% are sort of divvied among the other types of gifts, whether it's charitable trusts or lead trusts, life estate agreements, gifts of retirement assets, life insurance gifts, etc. So let's start and talk about the will or estate bequest. A bequest gift to a club happens at the individual's death. This is the simplest type of planned gift in many ways and one of the easiest to implement. Many people, if they're asked and realize that your club would welcome such gifts, many people would desire to benefit your club, but some of them aren't able to do so now, but they're happy to donate property or assets to you upon their death through their estate. The advantage of that is that a donor can retain ownership and use of their property during their lifetime and still benefit your club by leaving the property to the club at their death. A donor can leave property to your club by including a bequest in his or her will, or in the case of property that passes by beneficiary designation. That would be such as individual retirement accounts, IRAs. There's a beneficiary form, and they could say if they are married and neither spouse is surviving, they might say, well, I want a portion of this to go to my club, I want a portion to go on to my kids, grandkids, etc. So it's either done in a will or in a living trust, or it can be done via a simple beneficiary change. Next, what benefits are there in a bequest? As you can see, a bequest is simple to understand and easy to implement. It doesn't affect their current financial status. They can still use all of the property during their lifetime. The benefits of a bequest include a nice gift to the club. So the club would receive cash or, in some cases, property. There is also, for the donors, an estate tax deduction. And that is especially important if you have a non-married or a single donor, if their estate is over about $5.3 million, or if it's a married couple, if their estate is over about $10.6 million, the estate tax would kick in on everything over that. So you could have an individual that has a very, very large potential estate tax bill where everything over that deductible amount can be given to charity, and they can avoid most or all of the estate tax. The amount that is given to a club is not subject to federal estate tax. A bequest also preserves lifetime flexibility because they still own and have control over the property. Next slide. The charitable gift annuity. Next to the will, the charitable gift annuity is the most popular type of gift plan. In this case, a lot of times a donor may want to write a check out. Let's say they want to make a $10,000 gift to your club, but they really aren't in a financial position to do that. Maybe they're dependent upon that income to supplement their retirement. However, they might consider entering into a charitable gift annuity agreement. A charitable gift annuity agreement is a contract between the owner and the charity. In exchange for a gift of cash or marketable securities, the charity agrees to make fixed payments to the donor for their entire lifetime. A gift annuity contract can begin making payments immediately, that is within 12 months. That's called a current gift annuity. Or they can pay into the gift annuity now and defer payments for at least 1 year, which is called a deferred gift annuity. Next slide. Let's take a look at some of the gift annuity benefits. They provide many benefits. A donor gives cash or marketable securities to a charity, and in exchange, BGCA actually is the one who would make the payments to the donor or donors, if it's a two-life gift annuity, for their entire lifetime. It's backed up by all the assets of BGCA. We take on the risk of that, which means that if a donor lives a year after they take the gift annuity, or if they live to age 100 or more. I had one gift annuitant live to age 102, and the baby of the family was 86 years old. So when I met the three sisters, one was 86, one was 88, one was 95, and they say, you know, we love gift annuities. You know, sometimes we might think, well, if they take out a gift annuity, it adds 20 years to their life. Well, we can't really guarantee that, but a lot of times it helps. It helps them not worry about the future, because this annuity payment, this dollar amount of the annuity payment is not dependent upon our rate of return when we invest those assets. Instead, the payments are based on a rate schedule. We use a rate schedule set by the American Council on Gift Annuities. And under the ACGA's rate schedule, the older a person is when they take out a gift annuity, the higher the payout rate. Generally, average age for a gift annuity is about age 76. The rate for a 76-year-old one-life gift annuity is about 6%. The maximum payout rate would be for an individual one-life gift annuity if they're age 90 or above. That rate would be a 9% payout, and that's guaranteed to them regardless of economic conditions for as long as they live. The neat thing about it is that when the annuitant receives their annuity payment, which comes either annually, semi-annually, or quarterly, they get to select, part of the payments are tax-free. So if you compare, say, a gift annuity with partially tax-free payments, and they get a charitable tax deduction up front when they take the gift annuity out, compare that to, say, if some of their money is in CDs or money markets, where the entire earnings is taxed at their ordinary income rates. It can be a very nice financial asset, and it works very nicely into their retirement plan. Next slide. What does the gift annuity donor look like? First of all, it is usually the more senior donors who want fixed payments. They don't want to have to worry about the market and what's happening with their stocks. Usually they are cash donors. A lot of times they'll have a lot of fixed income type investments, CDs, money markets, and let's say Mrs. Jones has 6 CDs in the bank. Well, maybe when each of those comes up to maturity, she might consider taking 1 or 2 of those CDs and transferring that money over into a gift annuity, which eventually is going to benefit your club. We might say that a lot of times they're asset rich but cash poor. Typically, the donors will give over $10,000, but the requirement to take out a Boys and Girls Club's gift annuity is that each annuity will be at least $10,000 initial deposit, and they're at least 60 years old. So 60 years plus in age and $10,000 plus to contribute. The average age for gift annuitant is age 76 when they usually take out their first gift annuities. However, it's good to market to age 60 and above.
Terry, you have a question here. If we had a donor who was interested in learning more about a charitable gift annuity, is there someone at BGCA who could help us with that information?
Yes, we would be glad to help you. You would contact your director of RD Consulting, depending on what region you're in. I'm in the Southeast region. We have Kelly Tetzlaff out in the Pacific region. Mary Ann is out there also. So depending on which region you're in, but contact the BGCA RD office or your gift planning representative, your RD Club Consulting representative, and they would be glad to help you. We have additional materials, including a marketing campaign for gift annuities. It tells you week by week what to do. Very easy to do. The main thing here is getting this message out to your donors.
And I'd inject too, if you can't figure out who your RD contact is and you need to talk to somebody, talk to your director of organizational development, because they're always able to put you in touch with the right person.
Yes, very good. Okay, so let's talk about charitable remainder trusts. A charitable remainder trust is a trust that receives cash or property from a donor, and then those sale proceeds are reinvested, and that trust makes payments to the donor for their entire lifetime, lifetimes if there's more than one beneficiary, or they can set it up for a term of years, for 10 years, 20 years, but most of them set up this trust for their lifetime or lifetimes. When, let's say it's a 2-life remainder unit trust, after the second beneficiary's death, then whatever remains in that trust goes to charity. Now, it can be one charity. If your club is their only charity, which in most cases isn't too likely, a lot of times people will divvy up and divide that remainder portion amongst 2 or 3, sometimes 4 charities. But these trusts tend to be larger. They tend to be at least several $100,000 when they start, and they can go into the millions. So the opportunity is great. Your profile donor, we're going to talk about that in a minute, but just remember that, again, similar to the gift annuity, the donor is going to get lifetime payments in most cases, but that payment on a charitable remainder trust could fluctuate with the market, whereas with the gift annuity, that dollar payment always stays the same for as long as that annuity is in force. So let's look at the benefits of a CRT. The benefits include the donor receiving a charitable tax deduction during the year in which they contribute that asset to the trust, and bypassing capital gains tax on the sale of that asset. That is key. For instance, if someone has a huge appreciated stock, if they would sell that stock on their own and reinvest those proceeds, they would have to pay out a capital gains tax, which could be anywhere from 15% on the gain up to 20% or more. The better way to do that could be, okay, first they would first their attorney would draft the trust agreement, and they would transfer the stock from themselves into the charitable remainder trust. The trust then would sell that appreciated property or asset, and because it's a charitable trust, there's no capital gains tax on that transaction. So they have all of the net sale proceeds to be reinvested to provide them with a lifetime income. Someone has a piece of property, real estate, and it's got a huge gain. Same thing can be done there. Roll it into the charitable trust, trust sells it, no capital gains tax. Same thing can be done with a business. Say someone has a family-owned business. Same thing. So you're getting the idea. CRT can last for a lifetime. Most of them do. Some of them are a term of years. Now, the amount of the payment that goes to the donor has to be at least 5% of the value of that trust each year. So if they start with $100,000, during that time, they have to receive at least $5,000 in payment over the next year. It's negotiable up. The rates are negotiable up. I'd say in most cases, for it to qualify as a charitable remainder trust, the payment rate would be, depending on their age, anywhere from 5 to 7.5%. So that gives you an idea. But we have software that can calculate all these for you. So if you have a prospect for any one of these type of gifts, get in touch with your DR or your DOD or your director of RD consulting, and would be happy to furnish that information and actually help you inform, educate your donor, and help you close the gift if that's your desire. Okay, next slide. What does the charitable remainder trust donor look like? For a charitable remainder trust, a donor with cash or appreciated property with a value of at least $100,000 who wants increased income would most benefit from this plan. As I said earlier, most of these trusts nowadays are considerably more than $100,000. Many of them exceed several $100,000 or even $500,000. So it's someone who has, they have a lot of assets, and in particular, assets that have appreciated a lot throughout the years, and they want to convert that into a lifetime income stream. But they really don't want to sell it themselves because they don't want to pay that capital gains tax. So they can avoid that by having the charitable remainder trust sell that and reinvest for a lifetime income for them. How do they implement the charitable remainder trust? First of all, it's usually their attorney who drafts the trust document. We can also help your donors because the software that we have, in addition to illustrating how this plan works, it also can provide a boilerplate charitable trust document, which they could then take to their attorney, and if their attorney is able to use that document and just tweak it a little bit, it will cost a lot less than if their attorney drafts the document from scratch. If their attorney drafts the entire document, usually it costs several $1,000s for a charitable trust to be drafted. So that'll give you some idea of the cost. But again, these are larger gifts, and they're going to save a whole lot more than that in taxes because of the income tax deduction even in their first year. So the donor transfers then cash or appreciated property to that trust. The trust sells the property tax-free, no capital gains tax, and then the trust, and they have to name a trustee. They wouldn't want to serve, in most cases, as their own trust. There's just too many complications there. So they would name a trustee. It could be a trust company. It could be a company who's set up to invest and handle these type of trusts. Some of the major brokerage companies have trust departments too that can handle charitable remainder trusts. And they also, the trustee has to submit the income tax return each year and make the payments. So that is the charitable remainder trust. Let's take a look at sort of, we call it the opposite of the charitable remainder trust. If you remember the charitable remainder trust, the donor is receiving the income. The charity receives what's left after the donor's deaths. So keep that in mind as we talk about the lead trust. A charitable lead trust is a trust that receives cash or property from a donor, makes payments to your club for a specific period of time, and at the end of that period of time distributes the trust property back to a beneficiary, typically a family member or members. So the lead trust is the opposite of a charitable remainder trust. In the remainder trust, again, the income goes to the donor, usually for a lifetime, but it could be a term of years, and then what remains after that trust is complete goes to the club. The difference in the lead trust is that, say, if the donor puts $1 million of cash in the lead trust, your club, if it's a 10-year lead trust, your club would receive the income from that trust. So here's a planned gift that is also a current gift. You would receive, your club would receive the income for X number of years, and say if it's a 10-year lead trust, at the end of 10 years, then that, what remains in the trust goes back to the family. It could be grandkids, kids, whomever. So let's take a look at the benefits of a charitable lead trust. By the way, with earning rates so low in today's economy, there has never been a better time for the charitable lead trust. So if you have an uber wealthy donor or prospect, and you know that they're going to have estate tax concerns because their estate is well over $5.5 million if they're single, 10.6 million or so if they're married, this could be a concept that could help them because they're looking for ways in which they can minimize estate taxes when passing on property to their family. So some of the benefits of doing a charitable lead trust include a gift or estate tax deduction where the donor receives a current federal gift or estate tax deduction for the payments that will go to the club. When the donor gives the property to a lead trust and that property plus growth passes to his or her family, there will be no additional tax on that appreciation. So there could be some tax, but they're minimizing the estate tax exposure of transferring that on to their family. What does a charitable lead trust donor look like? Who's the target donor? First of all, have a large estate. They're going to have estate tax issues. The donor wants to pass the specific property, whether that's cash or stock or whatever, onto their family. That particular asset usually has high growth potential over the years. They want to pass it on with low gift or estate tax. And again, the typical lead trust is at least $1 million. So again, this is for multi-million-dollar estates. Maybe you don't have 100 prospects like this, but you might have one or two. And if they're getting up there in years and they're looking for ways to pass on their estate with minimal tax or reduced tax and want to really benefit your club in a large way, this could be a very nice gift for them to consider. Now, how do we implement this? Again, we're back to the attorney. Usually the attorney is going to draft this trust document, and then step 2 would be the donor, with the advisor's help, transfers cash or property, income-producing property, into that trust. And then step 3 is your club would get a regular payment each year. Each year, the earnings basically from that trust would be paid out to your club. And it would be paid out to your club for the term of years that the donor selects, typically 10 years or more. And then after that, say 10-year period, if that's what they select, then that asset, whatever remains in that trust, passes either to the donor or back to their family. So that is the charitable lead trust. Next, let's switch gears a bit and let's talk about real estate. Real estate. Life estate reserved, commonly referred to as a life estate. In a life estate agreement, a club accepts a gift of property, real property, either a personal residence or sometimes a farm or a ranch. And the donor retains the right to live in and or use the property for his or her lifetime. Now, why would they do this? Donor's going to receive a current tax benefit for doing this now, as opposed to leaving this home to your club, say, in their will or their trust. So let's take a look at the benefits of the life estate. Okay? The donor is going to receive a current federal income tax deduction in the year that they transfer that home or farm or ranch to your club. All of the years in between now and the donor's death, the donor is able to use and control that home or farm or ranch during their lifetime. So they continue on doing exactly what they've been doing, but they get that tax deduction now because you're going to receive that property after their death. And this, I will mention, is an irrevocable gift. Going back, the gift annuity is an irrevocable gift. The charitable remainder trust itself is irrevocable, but in the charitable remainder trust, they can change charities if they wish.
Terry, you have a question.
Yes.
Does the club need to be using the land or property donated for the club's use, or can it be sold after they receive the gift?
Okay. This, usually what happens is the property is liquidated. It's liquidated usually, well, let me back up. Let me talk. Okay, we're talking about the life estate, I presume, here. Yes, okay, the life estate. That is up to the club when they receive this home or property. If the property is very valuable, more valuable even than the home, and they want to keep that property, then they need to check with their tax counsel. But I have known of cases where charities have kept the property, and with the club, I mean, if this happens to be, say, a downtown location where it might be a good location for a club, and maybe it's a commercial property or something like that with an apartment up above, they may want to consider keeping it. But I'd say probably in 90% of the cases, the charity would sell the home and then have the cash to use how they see fit. What does the donor look like? Usually this is someone in their 60s or older. They also have enough liquid assets available for living expenses, but they do desire a current income tax deduction. So that's, again, that's why they do this now rather than putting the home in their will or living trust and have it go in that manner. It's the difference here is the income tax deduction. So how do they implement this trust, or this gift plan, I should say? A donor executes a deed, actually a deed transferring a house or a farm, in this case to the club. In the deed, the donor retains what we call a life estate, which again is the right for them to live in the home and to use it for their lifetime. At the time of this gift, when that happens, the donor and the club enter into a separate agreement called an MIT, which stands for Maintenance, Insurance, and Taxes. And that agreement specifies the donor's responsibility with respect to the home, that the donor will pay all maintenance, insurance, and taxes during that time, during their lifetime, when they are having use or live in that home. Very, very important. The charity doesn't want to get stuck with paying those expenses. So that MIT agreement, in addition to the deed, is very, very important. After the donor passes away, the asset then can pass to the club, and the club can use that or sell it, whatever they desire. Depending on all these types of gifts here, you might have executed with your donor a separate gift agreement which outlines in detail how your club will use this gift. In other words, does the donor restrict this gift? They may, but they may also just give this gift to your club outright. So it's up to you all to decide how you want to use it. But that's at the donor's discretion. So just that, I want to add that might be something that enters into the picture also. Any other questions about these gifts or any other types of planned gifts? Anything else come to your mind as we were talking about these various gifts? Any questions at all?
Yeah, here's one for you. This says, I'm a CEO with no RD professional on staff, and I have no experience in securing planned gifts. What is the best practice for reaching out and getting local financial planners and attorneys to think of the club when it comes to counseling their clients? Is it a best practice to hold a seminar at the club, inviting them to attend and learn more about the club's gift planning options? Should we seek help from our regional director on this, or what should they do? And this person is in North Carolina.
Okay. That is great. That is a wonderful question, and I have good news for you. You're able to do something quite substantial with the background, the situation that you presented. In other words, I would check with your RD director. It may be myself, it may be Amy Sexton, depending on where you are in North Carolina. But the basic idea would be, one, to have what we call Leave a Legacy program, where you simply would encourage your donors and prospects to remember your club in their will or estate plan. And if you go to the handouts afterwards, you're going to see a copy there of the Will and Trust Planning Guide. That, I would get that piece of literature to everybody I could, board members, current donors. I always left it behind on my face-to-face visits of any kind, because keep in mind, about 80%, close to 80% of adult Americans either don't have a will or it's outdated. So this little piece, this booklet, can be of great help to them. But just to make them aware that your club would love to receive bequest gifts. A lot of people might not realize that you're in that position. So you might have taglines on your stationery, your business cards, leave a lasting legacy, remember Boys and Girls Club of in your will or estate plan. And we can show you a very simple marketing plan, even electronic, where you can get that message out. But it's getting the message out. Make a will, update your will, and consider naming us as one of the beneficiaries. Second part of the question, we have a formal program to, and it's turnkey, to establish relationships and collaborative working relationships with your local professional advisors. Briefly, the way that it is usually done, the way I have found that it's most successful, is we start out with visiting, say, name the top 2 or 3 estate planning attorneys, CPAs, trust officers, wealth advisors in your town that you would like to get to know and that you would like to learn more about your club. And then we would schedule about a 30-minute visit. A lot of times they keep us longer than 30 minutes, but your director of RD Consulting would be happy to go with you, and I'd be happy to talk to you about the details of that program. Just either give me a call or send me an email, and we can get that done. That is a great way to leverage your small staff. In the past, I was a one-person plan giving shop in several charities I worked for. And one of the ways I really leveraged my time and leveraged and increased gifts was to build these relationships with the advisors that already have as some of their best clients our current donors and prospects. But just to get them to bring up that charitable giving question, get to know our clubs, is invaluable. So yes, we have something in both situations for you, and something that it isn't difficult to do, and it's not going to take much time for you to do that. Any other questions? Okay, let's talk about our role, the role of the Director of RD Club Consulting. It's really to provide counsel and mentoring for CEOs, staff, and board. How can we very simply start out basic? We walk before we run, but start out with the basic type of gift. Your Heritage Club is the recognition society for all individuals who make planned gifts, so inviting board members first to become a part of that Heritage Club and then taking it to the public after that's done. But we have many resources to help you develop the outreach. What you're trying to do with your marketing plan for plan giving is inform and educate your donors and prospects. Believe it or not, most of them do not know what these specifics of these various plans can do for them. And by sharing this information with them, and you do that on a consistent basis, when they have a certain life event, say, that triggers a question about, well, you know, I need to make this will. It's before our summer vacation. We've been meaning to do this. And, you know, I saw a while back that my Boys and Girls Club has some information about doing this. Maybe I need to give them a call. That's what you want, them to get in touch with you. But the other thing that does, if you're informing and educating them about your club and various ways that they can make these type of gifts, when you go visit them, you're going to have a much more informed and educated donor. So you're not going to be starting out your discussion at ground zero. At one time, a lady called me up and said, Terry, I saw in your e-newsletter a couple weeks ago, I think I need one of these charitable remainder trusts. Well, I mean, how many people call and say that? Not many. But she had been reading the literature, and she said, I'm updating my will and my estate plan. Can I talk to you? So what we have available to you are brochures, e-newsletters about gift planning, website, the plan giving website, if you've not been there before, that BGCA has created for use of our clubs, is clubgift.org. All one word, clubgift.org. So I would encourage you to go there and start clicking around, learn what's there. The more educated you are and informed you are, the better you're going to pick up on cues when you're visiting with these folks to maybe include something about a planned gift, a statement that might help them. Also, we're available to provide assistance to help you actually close gifts. So if you want us to go with you to help you close a trust or gift annuity, we are available to do that too, and we'd love to be able to do that. What's the role of the club? First of all, to get a list of your donors and prospects together, and then we, along with you, would help identify those who might be the best prospects for a planned gift. We have Wealth Engine, which is a screening device. If you want to get involved with that, if you go to the Advancing Philanthropy training, you will be eligible to use that program, and that is a great tool to use to help find out of your database who might be the best prospects. And you're looking for people that own a lot of real estate, with large retirement funds, that own appreciated stock. So it helps identify who might be the best prospects for particular type of gifts. We're also available to help you develop and implement a marketing plan, and that also includes gift acceptance policies, plan giving policies, help you put together in your RD team or your RD committee on your board a certain group of them that takes a look at plan gifts and helps promote that concept throughout your club and in the neighborhood. Again, we talked about helping you to close gifts. We'll be ready to do that, and we always love to do that because that's what it's all about. Two of my mentors were charitable estate planning attorneys, and one thing that they said many things, but one thing that really stuck out to me was they said, Terry, remember, in plan giving, nothing happens until the documents are signed, which means that they might have very good intentions. They might say, oh yeah, I'm going to include you in my will, but if they never make a will, that gift will never come to fruition. And also their family will never be protected. So it's important that we give them an easy way, and we have a system that makes it easy, cost-effective, and low stress for them to get these various plans in written form, get with the attorneys, get this done so that everything is signed, sealed, and delivered so that it does for their family what they want done, and also it benefits your club. The most important thing that we start with is always stewardship. You want to know where to start, and that is develop a good stewardship plan. You never can thank a donor too much. And that's where I would always start this plan. If you're looking to get into more, to do more face-to-face conversations with your donors, always best to start with a stewardship program. Thank them, and thank them again, and thank them again. Many different ways. Let them know what their gift is doing, and let them know about the lives that they're changing. That's where you start. That's where you start. So if you have Heritage Club members, you have Lifetime Giving Society members, you have Millbank members, that's a great place to start your face-to-face visits. And as far as that goes, that's for board members, should be doing those. CEO, development staff, everybody should be out there thanking their donors and recognizing their donors. And that is a wonderful way to get those donors to give at higher levels and to make more gifts. One thing about charitable gift annuities that I didn't mention, and I will before we close here. Once an individual takes out their first 1 or 2 gift annuities, many annuitants take out multiple gift annuities over the years. I had one donor, this elderly lady, started taking out gift annuities when she was about 67, 68, and when I left the organization, she was 90, she had 26 gift annuities. We knew every year she was going to take out either 1 or 2 new gift annuities. And she did that because that gift not only provided her with income, but we stewarded that gift very, very well. So that is critically important. Folks, we have 2 minutes left. I want to tell you about a couple things here. We have a more advanced plan giving webinar December 1st. What we're going to do there is actually I'm going to put out about 5 or 6 donor situations, and then we're going to match the donor's situation up to the appropriate type of gift plan and talk about that in detail. So in essence, it'll be a case study, but it's not going to be just, well, here's what this gift is. We're going to say, well, John and Mary are about to retire. They're looking for more income. They have a lot of appreciated property. What are some of their choices? That type of thing. We're also going to talk about the importance of working with your local professional advisors. That is very key, and that can greatly multiply the dollars coming to your organizations if you start building relationship with these folks.
Terry, you've got one question here, and Jennifer, I'm going to answer this one. I would love to attend December 1st, but it's Giving Tuesday, so many directors of development may be swamped that day. All of the webinars that we do through this webinar series are recorded and posted on the Fundraising Bank at fundraisingbank.org. So you can get on there anytime that you want and listen to any of the webinars from the series that you've missed. Those few webinars that were recently canceled due to illness will also be recorded and posted on there too. So any that you've missed, any you'd like to share with board members, or any that happen on Giving Tuesday, you can get them on the Fundraising Bank.
Thank you, Susan. Very, very good. The recording of these is really great. It's a great service. You can go back, and even if you don't miss one, if you want to replay it, learn a little bit more, that's a great idea. But we're here to help you folks. And for those of you who may be in attendance today in the Southeast region, I'll be glad to talk to you about anything related to individual giving, any help that we can give. We're privileged and feel great about helping you in any way we can. So please do contact us. We're coming into year-end giving. Still haven't heard anything about the extension of the IRA rollover gift plan, but if we do, we'll get that word out to you along with the sample email blast that you can send out to all your donors age 70 and a half and above. Probably only going to have a few days to get that out, but as soon as we hear that it passes, we'll send that information on to you, and wish you all the best in your year-end giving. If we can be of any help, or if you run into a situation where you need some assistance with the technical aspects of any of these gifts as you're talking to folks, please do give us a call. We'd be glad and privileged to help you anytime. Thank you very much.
Thanks, everybody.